On March 17, 2026, a massive 28-page short seller report targeted the digital lender SoFi Technologies. The equity markets responded immediately. Trading volume reached 157.5 million shares, nearly triple the three-month average. Shares fell as investors weighed the report against geopolitical tensions in the Middle East and hawkish signals from the Federal Reserve. The attack came from Muddy Waters Research, an activist firm known for forensic accounting scrutiny. Their 28-page report challenged the sustainability of SoFi's bank-driven growth. Muddy Waters labels SoFi a financial engineering treadmill. The firm alleges management utilizes aggressive accounting maneuvers to inflate profitability metrics and hit bonus targets, while shareholders face constant dilution. SoFi management issued a denial within hours. CEO Anthony Noto purchased 28,900 shares of company stock in the open market, spending approximately $500,000 to signal internal confidence in the firm's financial reporting. This clash tests the validity of fintech valuations. The outcome depends on whether these multiples reflect actual technological efficiency or the balance sheet of a struggling subprime lender. The conflict centers on a 90% discrepancy in SoFi's reported 2025 profitability. This is SoFi's publicly reported 2025 adjusted EBITDA, $1.054 billion. EBITDA is a metric that approximates a company's operational cash flow by looking at earnings before interest, taxes, depreciation, and amortization. Muddy Waters calculated the actual adjusted EBITDA to be $103 million. To understand how Muddy Waters arrived at a figure nearly $1 billion lower than the company's disclosure, we will break down the 4 accounting bridges the short seller used in their forensic analysis. A profit discrepancy of this scale in a publicly traded bank implies a binary outcome. We are looking at either a historic miscalculation by a short seller or a failure of institutional auditing. The forensic waterfall begins at the reported $1.054 billion. The first deduction is $194 million in marketing expenses. Unlike peers who expense these costs immediately, SoFi capitalizes them, moving them off the income statement and onto the balance sheet as an asset. Muddy Waters argue this was chosen to protect adjusted EBITDA targets tied to executive performance bonuses. The second deduction removes $247 million in fair value gains in the student loan segment. Fair value is the estimated price an asset would fetch if sold on the open market today. These are paper profits generated by SoFi's internal valuation models. The report claims SoFi discounted its consumer credit at a rate of 3.89%. That 3.89% rate was 27 basis points lower than the 10-year U.S. Treasury yield, the risk-free benchmark for the cost of capital in the United States. Muddy Waters contends discounting unsecured consumer loans below government debt rates is economically incoherent. They argue this creates a negative risk premium, pulling future profits into the current quarter. The waterfall chart continues with a third block, $259 million in fair value gains tied to the personal loan portfolio. This dispute involves the charge-off rate, the percentage of loans unlikely to be repaid. SoFi reported a 2.89% personal loan charge-off rate, while Muddy Waters calculated the actual rate at 6.1%. The gap stems from delinquency parking. GAAP mandates a charge-off at 120 days delinquent. Muddy Waters alleges SoFi moves these loans into off-balance sheet vehicles just before this limit, removing the defaults from public credit metrics. Removing these defaults keeps the reported charge-off rate low. This optimistic data then feeds into the mathematical models used to value the remaining loan portfolio. Because the models assume lower default risks, they produce higher valuations. These marks are booked as $259 million in non-cash gains on the income statement. If this rate is reality, it suggests SoFi is under-reserved for impending future credit losses. Muddy Waters argues they use structuring to hide deteriorating loan quality. The final deductions are $251 million in unrecorded liabilities and $96 million in seller-financed subsidies. This brings the forensic waterfall total down to $103 million. One specific allegation involves a Q3 2024 transaction. SoFi CFO described it to investors then as a sale of senior secured loans at par. Muddy Waters cited public uniform commercial filings to challenge that claim. The UCC is a system for recording secured debt. A September 2024 filing identifies a SoFi subsidiary as the borrower and JP Morgan as the senior lender. This involves accounting standard ASC 860, governing the transfer of financial assets. If the seller does not surrender effective control, it must be recorded as a secured borrowing, not a sale. If the filing is accurate, SoFi booked hundreds of millions in loan proceeds as revenue while omitting the corresponding debt from its balance sheet. The report also claims SoFi lends external buyers 80% of the capital they need at a 5% interest rate, specifically to purchase SoFi's personal loans. Muddy Waters argues this circular, seller finance structure manufactures false market validation, using below-market rates to artificially prop up the company's balance sheet marks. The report also alleges violations of ASC 810 regarding variable interest entities, or VIEs. A VIE is a legal structure where an investor has a controlling interest, even without majority voting rights. Under Dodd-Frank regulations, companies selling securitized loans must retain 5% of the credit risk. Muddy Waters found SoFi retains this risk horizontally, holding 100% of the Class R residual certificates. By holding this entire $125.5 million first loss piece, SoFi absorbs the initial defaults. Under ASC 810, this makes SoFi the primary beneficiary. Accounting rules require primary beneficiaries to consolidate these entities. This would force years of off-balance sheet debt back onto SoFi's books, shattering their tech growth narrative. SoFi's primary defense relies on its status as a highly regulated financial institution. Management points out that as a bank holding company, SoFi is regulated by the Federal Reserve and operates a national bank supervised by the Office of the Comptroller of the Currency, or OCC. The company also emphasizes that its financial statements comply with U.S. GAAP and the disclosure rules of the Securities and Exchange Commission, or SEC. This creates a paradox. For the Muddy Waters allegations to be accurate, there would have to be a multi-year failure of oversight by 3 separate federal agencies and the company's external auditors. Muddy Waters escalated the dispute by publishing 11 technical questions regarding the UCC filings and risk retention. The firm claims SoFi's investor relations team abruptly stopped communicating when asked for these specific details. Investors are currently caught between trusting the oversight of the U.S. banking regulatory framework or trusting the verified public filings presented by the short seller. Markets treat insider trading as a signal of internal truth. CEO Anthony Noto's $500,000 stock purchase during the sell-off was a public signal of confidence. Muddy Waters argues this purchase is insignificant compared to the estimated $58.3 million Noto and the CFO previously realized from the company. Those gains were realized through prepaid variable forward contracts. These are financial instruments that allow executives to extract cash from their stock up front while technically claiming they have not sold their shares. The next catalyst is the Q1 earnings report. Management will be expected to address the 11 questions directly or face a potential crisis of confidence. If SoFi provides GAAP-audited evidence that dismantles the report, the current 10.1% short interest could trigger a significant short squeeze. If regulators validate the forensic evidence, the financial engineering treadmill thesis gains significant credibility. A confirmation of unrecorded debt would likely lead to a sharp re-rating of the digital banking sector toward traditional bank multiples.